Welcome to Going Long with FCLTGlobal, the podcast that dives into the world of long-term investing and strategic decision-making, hosted by Sarah Williamson. Going Long features thought-provoking conversations with some of the brightest minds in finance, economics, and business today. Each episode will bring you exclusive interviews with renowned executives, investors, and experts who are driving change in the world of finance, getting their unique perspectives and uncovering strategies that have shaped their success. Whether you're an investor, a business leader, or simply curious about the forces shaping our global economy, join us as we explore the power of long-term thinking. This is Going Long with FCLTGlobal.
Welcome to the Going Long podcast. Today's guest is Mark Machin, co-founder of Intrepid Growth Partners and former CEO of CPP Investments. Mark is particularly special to our community as one of FCLTGlobal's founding architects in 2016 and our former board chair. From leading one of the world's largest pension funds to now deploying $500 million into transformational AI companies, it's safe to say Mark is the leader in managing patient capital and creating long-term value. So, Mark, welcome to Going Long.
Thank you. Great to be here, Sarah.
Right. So, Mark, you've had a remarkable journey from neuroscience at Oxford to Goldman Sachs partner in Asia to leading Canada's largest pension fund. Looking back, can you talk a little about your early medical and scientific training and how or whether it shapes your approach to long-term investing, particularly your current focus on AI? Just give us a little of the background there.
Yeah, so a couple of threads I could highlight there. One is science teaches that focus on analytics and data. You develop theses, you define experiments, you see if the resulting data supports or refutes your thesis, and you're building that in a cumulative way. And data is generally not 100% in one direction. There's probably a probability element to it, to analyzing the statistical significance of results. And so that data-driven, probability-driven approach, a cumulative approach, is very, very aligned to sort of data-driven investing processes. So I'd say that, that sort of scientific method is pretty helpful when you think about investing, the accumulation of knowledge, accumulation of insights, the fact that nothing's ever black and white, or very, very rarely. And so you look at things on a probability-driven basis. So that's something, it's a good grounding. Second thing I'd say, and this is much more specifically to what I'm doing today in the world of AI, is that a lot of the progress in AI over the decades has been inspired by guesses as to how the human brain works. That's what really inspired a lot of the work in neural networks. It was a guess as to how the brain is wired and operates. Having some grounding in that provides me with some perspective on the underlying architectures that have been used today and how they're working. It also, frankly, gives me a bit of an appreciation that we still have a lot to learn about how the brain really works, and frankly, how the inner workings of neural nets at these vast scales that are operating today are really working as well. But it provides interesting perspective on what we know and what we don't know.
Well, it's very good grounding for what you're doing now, that's for sure. If we take a step back to FCLT, you were instrumental in founding FCLTGlobal in 2016, and you served as our board chair. What was the catalyst when you sort of realized the investment industry needed a structural intervention to promote long-term thinking? And how do you see that mission from almost 10 years ago now evolving in today's markets?
Yeah, look, the original inspiration was clearly from my friend and predecessor, Mark Wiseman, and Dominic Barton, his work with Dominic Barton, who was leading McKinsey at the time. So Mark was leading CPPIB, Dominic was leading McKinsey. They worked together on this thesis. And the headline of all the research, the deep research they did that really caught my eye was that the majority of S&P 500 CFOs would forego investing in a project that would create long-term value for their company if it resulted in them missing next quarter's earnings by 1 cent. And that's clearly crazy misalignment. It's misalignment versus any long-term savings pool like CPPIB, other asset owners, frankly, anybody who's saving for their retirement, which is a lot of what personal savings, individual savings is all about. So most of that capital, the trillions of dollars in the world, has a desire for long-term value creation. They don't really care about that short-term, what happens in the next 3 months. That's sort of an irrelevancy. So clearly this was a misalignment of incentive where those people who were driving these companies were making decisions that were so short-term focused and not focused on the long term. So there was something broken in this value chain between asset owners, savings pools, the asset managers who are managing the money on their behalfs, boards, CEOs, the press, sell-side research, whatever it was. There was some misalignment and missignaling and misdirection in this whole value chain. So it was an urgent need at the time to create this organization to try and reconnect that in a much more constructive way, to create that long-term value and get people off focused on what was this unhealthy focus on the short term. So I'd say, in terms of today and today's uncertain markets, I try to dampen the tendency to always see, there's always a tendency to the current moment as more uncertain than what we've seen in the past. And that, by definition, it always is, because you don't know what's going to happen tomorrow. But we always seem to be at a crossroads, an inflection point, a paradigm shift, and we always think we are. Having said that, while dampening that tendency to see today as particularly extraordinary, I think undeniable there are very big shifts underway which can't be ignored, even if you have a long-term lens, because they are likely to be here for years to come, and that includes the geopolitical changes and the profound impact that technology is having. So I think having a long-term lens on those shifts and a long-term lens on what's not going to shift is pretty important. So I think the work of FCLTGlobal is still really important, as important today as it was back 10 years ago.
Great. Well, let's talk about some of those issues you've raised, like the technological shifts and geopolitics. One of the things another thing that has changed a lot since we started about 10 years ago is the shift from public to private assets and the rush into private assets. So maybe if we think about that, alternatives and private equity, private markets in general, are meant to be longer term. They are meant to overcome some of those things about the quarter that you just talked about. But today we're also seeing a lot of money flowing into those. So how do you think about the balance? Are private markets still private, or are they becoming more public? And what should we look for there? Because I do think that's a change that's been fairly important over the last 10 years.
Yeah, no, that's for sure. And I think, there's clearly there's much more of a merger of private and public markets, or it's sort of a spectrum. And I think one of the things that is helpful for illiquidity is that there are more mechanisms to gain liquidity when you have private markets. The risk of being of private assets is that is that illiquidity when you run into sustained downturn in public markets. And it obviously happened. It happened for a short period of time, for a few weeks running into COVID in 2020. And then there's been there's been periods of underperformance of public markets post the sort of 2021 stretch valuations as well. And that created that's created denominator effects. Has meant there was less cash for people to deploy for a couple of years or so. But I think there is this. There are increasing, massively increasing secondary markets. There's massively increased liquidity in secondary markets. That there are more marketplaces, even for smaller pieces, in the secondary market. So I think that it's and there's more vehicles that have at least quasi liquidity that are available for people. So I think when anybody's going into illiquid markets, they need to be really thoughtful and careful about their liquidity planning, about their scenario analysis, and there's always left field surprise that can happen that may impact that overall. But so I would say if you're an individual investor, you need to thought through some worst case scenarios of how much money you'll need, and then not get over your skis on deploying too much as an individual investor, and likewise as an institution. That when you can have sudden and then sustained downturns in public markets, you've got to make sure you haven't got over allocated to that illiquid exposure.
All right, let's turn to geopolitics then, and we're going to come back to AI, which is where we want to spend most of the time. But you spent over 2 decades in Asia with both Goldman Sachs and doing other things there. You've had a significant exposure to Chinese markets, CPP. I know you have been involved in global markets for long periods of time and are very close to it. So how do you think about these geopolitical tensions and how long-term investors in particular should balance the opportunities in Asian markets with the political and regulatory risks that we're seeing either from the home markets or there?
Yeah, so I think Asia overall is one question. China is another question. So Asia overall is 2/3 of the world's 60%, 2/3 of the world's population. It's 70% of the world's trade. It's massive part of the world, and so I think any investor is going to have some sensible exposure to that. I think with China specifically, the thing that's changed in the last several years is that the US is clearly determined that China is its adversary, and that's officially on the record as of January 2020. And most of the US's allies now agree with that posture. While that's sad for the world, it is a reality, and that is a massive change from the days of sort of open competition in the 2000s. When I was running around in China in those sort of Hank Paulson days, I'd say, of Goldman Sachs leadership, China was not an adversary back then. So today, capital has to decide: do you want to invest in an adversary or not? And if so, where and how? And some people say, look, not at all. Others say, well, look, as long as I'm not investing in military-connected companies, that's fine. And clearly, less capital leads to lower valuations and more opportunities for those who do pursue the opportunities and feel they can navigate the regulatory and other risks and figure out how to get to an exit as well. But that's the big change that's happened since my days there.
Yeah, it is a big change. It's a big change. All right, let's come back to AI, and maybe you could talk a little bit about what you're doing in Intrepid and the kind of, so as we think about the investments into AI, obviously there's a lot of hype, but also a lot of hope. We're early days, and so let's start with sort of your investment thesis as you think about how you're investing in AI, and then let's come back a little bit to sort of how you see these innings unfolding, if you will, and where the value may accrue, because I think that's one of the things that is puzzling a lot of people today, which is if there is value, which I'm sure there will be a lot of value created, who gets that value? But maybe let's just start a little more background on Intrepid and how you're thinking about putting money to work in this space?
Yeah, so in Intrepid Growth Partners, I co-founded with two co-founders. One is my ex-head of technology and growth investing at CPPIB, a guy called Mark Machin, who's 20 years investing across Fortress, CPPIB, and elsewhere in growth and technology. And then secondly, a guy called Ajay Agrawal, who has literally written the books on this question on value, where value is going to accrue to. So he's written 2 books on AI, one called Power and Prediction, and the other called Prediction Machines. And he's the co-founder of a massive incubator system for university-based science across the world, starting in Canada and the US, called Creative Destruction Lab. And so the 3 of us teamed up to create Intrepid Growth Partners, and we're focused on companies that have AI broadly defined. So AI, machine learning, predictive AI, generative AI, computer vision, natural language processing, etc. So the broad definition of AI, we're focused on companies that have that at the core of their value creation. And we're investing at the growth and scale up stage. So we're not investing at the sort of experimental technology stage where we're not sure whether a new technology will work. We're investing at the stage where the technology works, where it's clearly getting traction. And we're investing in enterprise-facing AI, which is less fad-driven than consumer-facing AI. It's more sticky, it's more sustained. And we're looking for companies that are creating real value, where you can understand the unit economics, where they're measurable, where it's creating cost reductions and ideally revenue enhancement for their customers. And key thing is long-term defensibility. And in particular, that can come from proprietary data sets, and it can come from all the other indices of defensibility in a traditional company. The final thing we look for is companies that have the potential to scale from being just a point solution to being more of a system-wide change, so that they can start offering their customers one aspect of a solution, and then they can expand into a much broader product suite and range of solutions. And that's more system-wide change. That's what my co-founder Ajay would call it.
And as you sort of look forward, or you think about some of the examples of the companies that you're investing in, I think you said there's, cost reduction. Ideally, there's revenue enhancement. Can you give an example of the sort of thing where you get cost reduction and then maybe revenue enhancement, and it's a point, and then it goes down the system? Can you bring that to life a little bit more?
Yeah. So let me give an example of a company called StackAdapt that we've invested in, which is a Canadian programmatic advertising platform. They're the leader for small and medium businesses in North America, and they can, with great efficiency. So, for example, imagine you are selling, fishing tackle in Kansas, and you have a small business selling fishing equipment in Kansas, and you want to get your equipment into the eyeballs of the most likely people in your area or across your region of the country that are going to buy your fishing equipment. You can get onto their platform. There's no minimum spend, and you can then you can self-serve. So you can use their technology to identify with great precision exactly the types of customers that are most likely to bite, to make a pun for fishing equipment, but most likely to bite, take the bait and bite for your equipment. And it does this by a huge machine learning capability, which trawls through 7 billion data points a second to decide exactly where the most effective point is, most effective place to place your advertising. and has huge customer satisfaction scores. And people keep coming back to this because they see how powerful and effective it is. So it is very sticky, and people then put more and more of their spend into through StackAdapt. And so it's had tremendous growth, and has been and continues to gain market share. So that's the type of situation where it sort of reducing the cost that you would require within a firm for a big marketing department or big analytics, and it's clearly increasing revenue by taking by providing by increasing sales for your customers. So that's one example.
And how would somebody have done that a couple of years ago? They would have just much more trial and error. They would just guess which platforms might work, and then they would have built some experience with the trial and error.
I mean, it's less efficient and less effective approaches. So there's always been, there's been some type of software. You probably had to have a minimum spend. You probably had to have someone who get on the phone with you, as well as navigating this to make it, so you have to do it alongside someone. It'd be more expensive, more clunky, and less satisfaction, because the data wouldn't be there for you to redirect so quickly. The fact, they can do this so real time, they can highly effectively respond to changes in each of these opportunity sets. They can target extremely powerfully and effectively. So it'd be less good. In both, it would be more expensive and less effective.
And as you think about an example like that, rolling through the economy, will the benefit from that? Where will the benefit of that go? Will it go to the customer because the end customer, the fisherman, because they will see, get a better product? Will it go to the company selling the goods? Does it go to the AI company, or does it go to the hyperscaler where they're probably, does it go to the cloud provider where everything runs? Like, how does that divide up over time?
Yeah, so I'd step back from that specific example and just look at overall. I mean, I do think as an asset owner, or anybody who's allocating a pool of capital, I think the way I think about it is you should probably have exposure to the semiconductors, so the NVIDIAs and AMDs, et cetera, of the world, because that's where the accelerated compute is happening. So you should probably have exposure to the factories for those semiconductors, which is the data centers, and some of the ancillary services, the power that's required for these for this generation of factories. And then you should probably have some exposure to foundation model companies that are able to not just be pushing out a model, but have actually been able to extend up to become an application layer company as well. So that, I'd say, Anthropic in the enterprise world is the current leader in market share, and then OpenAI, and obviously Gemini from Google as well. And I then say where we're investing is that application layer, which is where the massive growth is, which is companies that are really AI at the core, but are providing solutions for, whether it's in the medical field, medical diagnostics, hospital throughput, whether it's in industrial automation and robotics, whether it's in financial technology, whether it's in go-to-market technologies like StackAdapt I just mentioned, or other aspects of sales enhancement and sales enablement, whether it's in legal technology. For example, we just announced an investment in a company called BlueJay, which is a leader in tax law, providing tax law advice to accounting firms and others. And so it could be across any of these ranges of applications, but that's where over time an increasing amount of the economics are coming up to that application layer, and that's where a lot of value will accrue over time. But I think I think there's going to be value that's going to accrue to all of these parts of the stack. the biggest growth is at that application layer.
Okay, that's very helpful. And I saw Ajay do a presentation once where he sort of used the analogy of when electricity was introduced to AI, and in the early days, people just put electricity in their factories, but laid them out the same way that they had always been done when they had whether, I don't know, if it was coal fired or gas or whatever it was that came before, and then eventually figured out they could do things really differently. So and now, of course, it would be sort of silly to think about having a factory without electricity. So how do you think about, like, where are we in these sorts of steps? Are we just being more efficient and effective at the things we used to do, or is it still laying out the factory like it used to be laid out? When do we get to the point where we're just doing things that we wouldn't have done before? We're not just doing it more efficiently, we're actually doing something really different.
Yeah, I think we're in the early days of that transition from, what Ajay would call point solutions towards the system-wide change. I don't think the system-wide change has come yet, but it will do over time, and it will be profound over time. So in medical diagnostics and the healthcare provision, it's clearly an area that at some point in the future is going to look very different, because these technologies are better than humans at 24/7 analytics, 24/7 understanding of data inputs from all of us. We have sensors and biometrics and other omics monitoring of our biomes and gut biomes and all of our blood metrics and every other aspects of our physiologies, then we can have a much higher preventative approach to our medical provision, rather than this last minute crisis and treating things when they finally go wrong, and it's noticeable to us and a human that's looking at you. So I think we over the next several years, we're going to move in that direction. It's going to be very slow, given a lot of sclerosis in the system, so a lot of inertia. But I'm quite optimistic. Well, over time, it's going to have powerful system-wide change. I think some hospital systems are going to move faster than others on this. I think some systems are going to move faster. So some will do it because they have to, because they're just so overloaded. So one of the companies we've invested in the UK is called Skin Analytics, and they do skin cancer diagnosis at a level of accuracy of 99.8%. And that allows them to help the National Health Service to remove patients who are unnecessarily on waiting lists in the UK. So the waiting lists are overwhelming in the UK. It takes 17 weeks to see a dermatologist if you're worried about something that appears on your skin. Whereas with this technology, you can very, very quickly get a reassuring diagnosis that it's not skin cancer, and you can be removed from sitting unnecessarily on a waiting list, and the highest priority patients can then get seen by the dermatologists, and waiting lists can come down very quickly. So that's a point solution at the but can expand into broader dermatological diagnosis over time. And I think that approach can be used across a broader range of medical conditions over time as well.
So it sounds like, it's sort of each field has various applications and will continue to experiment and roll them out. And some, like as you said, medical care may take longer. Finance tends to be an area that moves pretty quickly. most of the more quantitative driven investing that we've seen in the financial community over the years has been driven by shorter term data points. And so, of course, as FCLT, our dream is always the long term investor in AI. Is there such a thing? Is there a way that you would expect over in the future, rather than the computing power leading to more and more trading, faster and faster all the time, putting together some of those, connecting the dots for the long term?
Yeah, so it's something we were pursuing with a decent amount of resource at CPPIB, and there is there's an ex CPPIB team that I've been investing with, who are continuing to try and pursue this methodology of using using machine learning to extract signal from noise over a longer term horizon, to try and create a prediction of what the market is not pricing over 6, 12, 18 month to 2-year horizon. I think they've had some success in doing that. I think the work is still developing. So I think that was the nirvana. That's what we wanted to develop. Was there a way of finding a signal that we're on those long-term horizons, which are much more aligned with what these big pools of capital really want, accumulation of value over time. Obviously people have found extraordinary ways of extracting value at the very short horizon, where the next tick is going, where the next millisecond is going to go. But this is hopefully, out of this technology will arise a way of extracting value over a longer horizon. I think the jury's still out on how that will perform over time, but there's certainly some very smart people have been working away on this for a number of years.
And do you see the back to the sort of the system wide, and if you think about the investment universe of active asset managers and sell side analysts and all of those sorts of things that we think about in that investment value chain, all the steps along the way, most technological innovations have eliminated intermediaries somehow. And so I'm wondering where, if we come back in 5 years and take a look at the investment world, obviously indexing is continuing to grow and active is falling. There's pressure on the sell side, but do you think AI just accelerates those current trends, or do we see something really different in terms of, for example, big pension plans investing directly in companies without the middleman, or any of those sorts of things? I'm asking you to look into your crystal ball a little bit.
Yeah. I think all the intermediaries are going to try to use technology to do things more efficiently. I think, and with law firms using technology, investment banks using technology, there's new AI-driven law firms that are being developed. There's new AI-driven investment banks that have been started. And so they're trying to do things with much leaner pyramids. And I think that's already, we're really starting to see that challenge in the job market for young people who are graduating right now of getting into these services companies, because, the pyramids, they're going from pyramids to, more rectangles here, so it's going to be the same number of junior people as senior people over time. So that's going to be a very interesting challenge for people getting into these businesses. I think whether it will totally eliminate intermediaries over time, that's maybe not. I mean, I think in wealth management, there's always been a desire to have have the a technology that can provide you with good investment advice that's as good as a human being. At the end of the day, people quite, it's amazing. The wealth management channel in the US is enormous, $20 trillion or so. The RIA world is massive and sustained. There's lots of creative destruction that goes on where companies consolidate and then new managers spin off and set up on their own all the time. But people like to talk to someone to get the final advice on things around finance. I think there's a role for technology for certain investment decisions, certain things. I think people who've been in finance, who are close to finance, are quite happy to rely on technology because they know enough. But I think people who, are not in the financial world really likes to talk to someone to get their advice in the end. So it's more technology that will make your advisor better, make your advisor more, smarter, better attuned to what you need, see better opportunities. And that's why, I co-founded a company called Opto Investments a few years ago to help provide the independent RIA with better access and information to help them do a better job for their end customers in that wealth management, wealth access to private investments.
So you mentioned the pyramid, the skinning of the pyramid.
Yeah.
As you well know, the mission of FCLT is to work with asset owners, asset managers, and companies, but really for the benefit of savers and communities. And if we kind of think about those savers and communities, clearly the savers who are invested in retirement systems or whatever may accumulate value from that. But as you think about the narrow pyramid, if you will, what does that do to communities? How do we think about that in terms of where the pressures then come in the world and in markets? Because this is changing. So many technological changes have happened over decades or generations. And this feels like it's happening over just a few years. So, to your point, somebody who entered law school 3 years ago wouldn't have known what ChatGPT was. And now they're coming out maybe this year and trying to figure out where to go. So how do you think about how that's going to play out?
Yeah, it is a tough one. I think there's going to be, you said, this is going to happen quite relatively quickly compared to other shifts. So there's going to be big change in structure of companies and the opportunity set for people who are graduating. I'm more on the optimistic side on there being a whole flurry of new opportunities that emerge over time versus the ones that are going to fade away. I don't miss, as in the days when I was a junior banker, which it's going to date me horribly, but we at Goldman Sachs we didn't have email until 1997. So for my first few years, difficult to remember, everything was on voicemail or other communications, so phone calls. So and then the amount of hours of my life I've lost sitting through the night sending faxes to multiple locations around the world so I could get comments back on something. So faxing and voicemail was an incredibly inefficient way of operating until email came along. And so I was very grateful as a more junior person not to be spending my time on those things and spending my time on much more productive things. And I think that's where this technology is going to lead to, is you're going to spend time on much more thoughtful and productive things that where you're providing additional judgment on top of what the technologies are providing to you. So it's going to be quite satisfying. And the opportunity set that I can see, it's never been easier to start a company. It's never been easier to find capital and advice to start a company. And it's never been easier to build a competing technology, code, and create a new technology. So that's where the new ideas and opportunities and interesting things are going to come from. I mean, it's something when you're an incumbent or you're a company that's got traction, you've always got to keep your eye out there for the clever students who are focused on building a new technology, doing something in a different way and in a new and exciting way. It's great for the world. It's great for new and exciting ways that people are going to be doing things in the world. But it's also you got to keep your eye on those when you are when you've got an existing business. But that's where I think a lot of the opportunity is going to come from. It's going to come from things that we don't even know today that are going to be built over time.
Well, I appreciate that optimistic outlook, and I actually share it because I do think that humans are incredibly creative and resourceful. But I'll ask you one last question just to wrap up. So if you were going to, look ahead 20 years and give us your crystal ball, what do you think is something that 20 years from now we're all going to say, wow, we really should have invested in that? What's the underappreciated investment theme today that if you had a 20-year time frame, you'd be pretty comfortable putting your money there?
I'll hedge my answer by giving 3 or 4 things. So first of all, I think probably today pretty much everything is appreciated. Capital's everywhere. So yeah, there is maybe some disconnects on the horizon. So I think biotech is probably one of the areas that's most beaten up at the moment. Still, there's probably opportunities there over and above everything else on that top of the horizon. I'd say, I'm certainly leaning into European and Canadian technology, which is very underappreciated. I don't want too much other capital chasing it right now from a selfish point of view, but I think that's something where I think everybody's focused on the US, quite rightly. Everybody's focused on the Valley, quite rightly. But there are other opportunities elsewhere in technology. I think we'll see interesting things come out of there. I'd say commodities over time, at some point, friends of mine who are experts in this area think there will be a super cycle because you'll get the revenge of the physical world. Everything that's been built, you still need physical stuff, but everything that we're building in the world, whether it's semiconductors and data centers and all the communications and devices, so that ultimately has got to come out of the minerals out of the ground, and there's less and less investment that's gone into that. So at some point, there's going to be a mega cycle. And whether that's in 20 years, that'll look great, but at some point they'll be able to play that. And then the final one I say is, probably quantum computing is the sort of next wave of technology that will be really interesting and will have some pretty significant implications. So I think quantum computing, I think today the valuations are pretty, recognizing some of the potential for the future of quantum computing, but I think that's also going to be, in 20 years' time, we're going to have, scale, whether it's fault tolerant or other types of quantum computing making real impact on, on whether it's drug design or computing extremely complex logistics problems, which just are beyond the capability of traditional computing today.
Well, those are exciting opportunities, and so I'll stop it there with saying thank you for your time today. Thank you for all you've done for FCLT Global over our 9 or 10 years of work together, and thank you for pushing where you're pushing now. It's really it's exciting where the world is going, and having that long-term and analytical mindset looking at it is really helpful. So thank you for your time today.
Well, thank you, Sarah, and thank you for your leadership since the beginning of FCLT Global. It's been remarkable, and you've built an incredible platform which has had a really big impact on global capital markets. So fantastic to have shared some of that journey with you, and thank you for your continued leadership.
All right, thank you.
Thanks.
That concludes another episode of Going Long with FCLT Global. We hope you enjoyed our conversation today and encourage you to continue exploring our resources and research at www.fcltglobal.org. If you enjoyed today's episode, don't forget to subscribe, leave a review, and share with others who may find value in going long with FCLT Global.